Hi, everybody, and welcome to this week's Middle Class Investor. This is Seth Martin. It is June 2nd, so we are done with May and off to June. And today I've got a chart of the Russell 2000 up, and the reason I have the Russell 2000 up is because, as you can see, it's at new highs. And there's a lot of talk about emerging markets and small cap stocks and so on and so forth. So you've got this interesting divergence going on in the market, which happens a lot of times at tops and bottoms. You get divergences. If we go to like a longer term chart, like a 20-year, of course the Russell I don't think has been around that long, but we'll look at what data is available. Yeah, you can see this kind of looks like a pullback, the end of some 5-wave move, and then we've got, which looks like 5 waves here, 1, 2, 3, 4, 5. So what's interesting is, the Russell is at new highs, but it's also interesting that it's at the end of 5 waves. And of course, once we have 5 waves, at a minimum, we should see a return back to the previous 4th wave low, actually just beyond it. Which in this case would be the 2016 low, about almost half of where we are right now. Now that could be just the beginning, or that could stop there and the Russell could lead, but I just thought that was interesting that the Russell's making new highs. If you look at the Dow Industrials, the Dow and the S&P are more important in terms of what's going on with social mood and the direction of the market and future direction of the market. Let me get back on a 5-year chart. So if you look at the Dow, gosh, I always do that. Sorry about that. Let's go back to charts. Okay, what I wanted to do was zoom in. Actually, what I'm going to do real quick is let me turn off studies, and let's just look at the price action. Sometimes it's easier to understand what's going on when you just focus on the price action. So here's the Dow, and you can see we've got this strong move down. We got this strong move down here, and then we had another strong move down here, and with some overlap in between. Now that usually means that the trend is down. In other words, the trend is not in the direction of choppiness; it's in the direction of definite direction, which looks to be more this way. And then you can see, this kind of looks corrective, to up here. You can, if you look carefully, you can kind of see. Whoops. Hit the wrong button. If you look carefully, you can kind of see, like an A, B, C. And if you look carefully here, you can kind of see an A, B, C. So we could have a 1, 2, and a 1. Let's just do it some other way, and 2. This is possible. I'm not saying this is the way it is. I'm just saying it's possible. And I'll show you some charts here in a minute done by EWI that also said that it's possible. Now, it might not be complete. It may need to make a new high above this high. So I would put, for this pattern, I would put a zone right about here for this pattern to still be in effect. In other words, if this comes up here next week or week after, comes up here and then turns around and sells off, then this pattern is looking good, okay? Or it could just continue, it could just sell off from here too. I mean, maybe what we did is we just closed this gap, this little bit of gap that was here, and then we sell off from here. And still this pattern would be check, okay? Where this pattern, is an X, is if this takes off and I'd say eclipses this high here. So if we go higher than this high here, then then this is on all big fat X, and maybe we're going to make new highs. So what is the scenario by which we make new highs? Well, let me go to a 2-year chart and zoom in, and I'll show you. If this is an A, B, C, D, E, okay, triangle, and this is 1, and we've had a 2, and now we're going to get a 3. Let's say next week's really strong, and you know we end up traveling. We take out this high, and we still have a lot of strength in the market, and we start to move toward this high. Well, then I would say the triangle is probably what's at play, and which would result in new highs. Okay, so that would be the triangle. Okay, so the triangle is you would draw it like right there and right there. So again, this is A, B, C, D, E, where this is a 1, and this is some sort of 2, and of course what comes after that is 3, right? So that's a possibility. Now, having talked about these possibilities, really the bearish possibility is the more probable, just because of what I've talked about before. You know, what was the market doing at these highs and lows? The internal structure, what's called the COT data, the commitment of traders data, the bullish bearish percent, all those internal datas, the advanced declines, the breadth, which is a volume, how much volume was up, how much volume was down, stuff like that. So to me, the bearish case is still at play. But if we take out, let's say on the Dow, if we take out 25,750, then I think you can pretty much give up on the bearish case and assume that this was a triangle and we're going to make new highs. But that should be it. Let's look at volatility for last week. The S&P looks the same. It's just a little stronger than the Dow, but they look the same. So volatility has continued, since we had this big spike, which was the January high in the market, and then the sell-off. Volatility's continued to come in. We're back down here around this historical average around 12 or 13. So there's a lot of complacency in the market, a lot of no fear, okay, no real fear in the market. Let's look at treasuries. Let's look at the short-term treasury. People are starting to, pull back on their estimates for how many rate hikes the Fed does this year. I would say, as long as we're trending upward, and maybe this is just a pullback, and we're going to start, it's going to start trending back up here and get above the line. As long as we're around this line, I think the Fed's going to continue to raise rates. If you start to see this roll over and come down, maybe they don't raise 3 times or even 2 times this year, but they're going to follow this 13-week treasury. So they don't want to get behind the curve, so to speak, on this particular chart. All right, let's look at the 10-year. The 10-year is obviously in some sort of pullback, which we expected here. I mean, you can kind of see. Well, let's back up here. Here was this kind of 1, 2, and then you can kind of see a 1, 2, 3, 4, 5. So we would expect the 10-year to pull back into this area at least. If it does, it could turn around and continue its trend. Now the next move up. Okay, so let's think about this. This is the low. This is the first move off the low. This is a 2, and this is a 1. So we get the same kind of situation we have in the stock market, just in the opposite directions. We got a 1, 2, 1, and then we're waiting on, let's say, a 2 to complete. Maybe the 2 goes a little deeper. Maybe it goes down here around 2.4%. But clearly this looks like an A, and then there's going to be a B up until it's done, and then C is usually, sometimes it's bigger than the A. In fact, a lot of times it is. Let's zoom in and let's just see if we can kind of pick a place. Sometimes it'll be like 1 point. Let's see, is this Fibonacci retracement? Yeah. So let me me do it like this. Actually, we got to kind of guess on where 2 might end. Let's say 2 ends right, or let's say B ends right about there. Let's say it closes that, well, let's say it ends right about there. Well, that would put the retracement somewhere between, well, right here on our thing, but I would say between the 1.618 and the 200. So maybe it doesn't go as low as 2.4, but maybe it stops at around 2.6 or 2.5. Okay. Again, use this opportunity to unload your bonds, because this next move up is going to be pretty dramatic, I think, and you probably won't have time to really get positioned out of this market. By the way, it doesn't matter if you're in high yield bonds or what other kind of bonds you're in, they all follow this particular 10-year treasury trend. I think that's important to point out. All right, let's look at Germany. Germany looks a little weaker than the US. You can see it had this big down move, but then the correction didn't go as high, and it looks like maybe it's starting, to go lower even from here. Japan, same thing, a little bit weaker than the US. The United Kingdom, I think, is stronger. Yeah, so the UK, this still looks very corrective, kind of A, B, C-ish. But it looks like maybe it's over and starting to roll over. So maybe the UK is leading the US market. I don't think from here this is going to go higher. It may go higher in the short term back to this line. Let's zoom in on this a little bit and just take a look at it. This looks like, very A, B, C-ish, where C is a 1, 2, 3, 4, 5. This is a very common kind of pattern. It's called a 3, 3, 5. So this is likely to be, a 1, and then you get some sort of ABC. Maybe it gets all the way back up here and actually closes the gap. That's possible. But looks like the UK is topped, and it did top in an area that we were expecting it to top in. So that's, initially I was expecting this blue area to hold, but we went back a little further. In fact, let's just do that real quick. Let's go back a little further, and we took a pivot off of this high right here, this swing high, which was in 2014, and the market moved right up into that decision point area and then rolled over. So I think we look pretty good for what we're looking for to happen in the UK market. All right, I guess we're done with that. Let's go over to the regular charts, and let's look at gold. I've been kind of punting on gold and silver. I think we're about ready to. Let me go to. I'm on a 15-minute. Let's go to a bigger chart here. Let's go to 20-year weekly. I think as long as we're above this line, I think there's a lot of bullish potential in gold, and so we're still above this line. We've had, it's violated a little bit, like intraday or intra-week, but then it's turned around. So let's say as long as we're above this line, I would be bullish gold, and I would look for gold to come up into this decision area, which we can make a little bit larger, a little bit longer, further out. And it might actually go through this area. I've got this area, this red line on here as well. It may be one of these things where intra-week it spikes up and then turns around, sells off. So you don't get a close beyond this yellow rectangle here, but you might get a wick, like a long wick that comes up in here. But we'll see. There's a lot of overhead resistance here right into this 1525 area. You can see there was just a lot of selling, a lot of ownership took place in here, and then was lost when this broke down through here. So I think this is a good decision point area. I think this is kind of, no pun intended, red line in the sand. If we're somehow able to break above this, then maybe gold continues to go up. But I would say first line in the sand is this yellow box. Second line in the sand is this red line. And silver, I think, is right there. You can see kind of something similar in silver. You got this kind of barrier triangle situation happening, where this could be like an A, B, and then C or something like that, where it takes off to the upside. And of course, that would the first line of that resistance would be right here, and then I've got a red line up here around 25.90 as well. So I drew some other lines out here, but I'm really not expecting silver to go that far. So let me go ahead and take that out. Let me actually shorten this. Be very surprised if it went that far up. I think there's just there's a lot of people wonder why is gold and silver. I don't know exactly. I've heard things like there's just during this whole run up there was a lot of paper gold contracts that were created in the futures market, and the implication is that there were more paper contracts created than there was actually gold in existence to back up the contracts. So you've got kind of this internal deflationary situation with gold and silver. I don't know if that's true or not. It sounds plausible. I mean, the finance markets do all kinds of crazy things, and the fact that they created more contracts than actually gold exists wouldn't surprise me in the least. So, all right, let's look at oil. Oil finally pulled back pretty sharply last couple of weeks, and this looks very corrective. ABC, kind of a W, WXY move, and so I would expect oil to come down below this 25.90 area over the next 6, 8, 9 months, something like that. But if you look at the really big picture of oil, this is a large ABC move. So in an ABC move, again, if you really study these waves here, this is kind of a 3, 3, 5. You can clearly see the 5-wave move here. 1, 2, 3, 4, 5, and then this is like another 4 and a 5. Because sometimes what'll happen is maybe the 2, maybe this was 1, 2, and then 1, 2, and so sometimes this is the first move down, let's say, or this one, let's say 1, and then this is a 2 up to here. So 1, and then A, B, C, 2. So this 2 here has to be proportional to this 4. So even though we see 5 waves here, 1, 2, 3, 4, 5, that's just the 3. That's the third wave in this larger 5-wave sequence. Okay, so we should see oil break below the 2016 low, and probably not much, maybe down to $20 or something, and then you can kind of kiss that goodbye. You'll never see oil that low again. So I think those days are over. And if you look, I don't know if I have a chart large enough here. You can kind of see I've got I don't know if you can see or not, I've got a 1, 2, 3, 4, 5. And so you got this ABC. Okay, so if this is wave 1 up from 1999 of this particular degree of trend, and this is the pullback, you can see this purple line here I've got is about 1575 is would be the ultimate low. So I mean, it's possible this comes all the way back to 1575, but once it's done going down, energy stocks and energy futures are going to be, I mean, there's just nowhere but up. I mean, there'll be pullbacks along the way, but if you were to buy oil stocks and oil here at 1575 and just that's all you ever did, you'd probably make a ton of money because of this pattern that's setting up here. All right, hopefully that helps you. That's weird. I'm missing my weekly chart of my 20-year weekly. It's not in the list anymore, so I have to put that back in there. All right. I guess that's about it. I want to go look at Elliott Wave, and I just want to remind you that kind of where we are in the trend. Okay, so where we are in the trend is we have a grand supercycle peak happening. So we're in primary wave 1 down. Let's intermediate wave 3 down, of primary wave 1 down, of cycle A down, of supercycle A, of grand supercycle 4. So what does all that mean? That means this is not going to end until we reach this degree of trend. This down move is not going to end until we reach this degree of trend. And right now we're only in wave 3 of intermediate degree. So now, I mean, it's possible that this is wrong, right? So the next best wave count is that we're in 2. And that, this is all got to finish until we get to a 3 top, and then you would have 4. Okay, so in other words, all these are just one step behind these. Okay, so the presumption is that this 3 has already happened, and now we're in 4. Okay, that's and because we're in 4, we're also in A of 1 of 3 down. Okay, but if this is wrong for some reason, then we would have to wait for 3 to complete, which means we'd have a wave 5 of 5 of 5. Okay, so let's just go back to the chart and just take a look at that. Look at that on the Dow Jones Industrial Average. So again, zoom in and draw this for you, because it's important to know what the possibilities are. Okay, so the possibilities are, this is a wave 4 triangle. Okay, the presumption in Elliott wave right now is that this is 5, and this is we've already started 4 down, which would be A. Okay, but if we're going to make a new high, that means this would have to be actually let me go back. Sorry. Okay. Let me go back and go to a daily chart because all the waves aren't showing up on the weekly charts. Let me go to a daily chart. So just again to remind you, if this were A and this was B and this was C and this was D and this was E, okay, then that all those little waves would make up 4, meaning that we would need a 1, a 2, a 3, a 4, and a 5 way up here. Okay, so we would need something that looks like this: here, 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 and then here. Okay, so that's the alternate. So if you go back over to the Elliott wave stuff, what they're saying, the next best, and that would end 3. Okay, if we had a 5 wave move up, we would complete this 5, and then that would end 3. But the presumption is that we're already in this. So here's a chart that you can look at, so you can see the wave. So here's the 1, the 2, the 1, and then the 2. So they're not showing it here, but it's possible this could get back up here and touch this line again and then give way. Anything's possible, I guess. They're showing kind of the small cap and the Russell. Really, I guess more of the small cap 600, but the Russell's kind of like this. So they're showing an idealized wave pattern here for a 4th wave, what they call barrier triangle, and then a 5th wave up. And you can see here's 3, and then an A, B, C, D, E for a 4, and then you can clearly see there's 1, 2, 3, 4, 5 waves up, and they're leaving for the possibility for another little pullback, and then another move up for a 5. So that's possible. It was kind of interesting here. There's all kinds of investor psychology stuff they talk about. People are eating gold on chicken wings, and it's a sign of complacency and decadence, and no fear and things like that. There's a lot about the emerging markets and how they're breaking down, and people are in the news saying, just ignore that doesn't matter, and these are all signs of real problems. The bond market, so we've had this wave 1 down, and then an ABC2 back up, and they're showing just the next wave 1 down of 3. So in other words, 3 has already started here. This is the 10-year Treasury. We just talked about this, and so you would expect, so far A has happened. So what you would expect here, this is kind of giving an idea how much time you have left to get rid of your bonds. So maybe B pulls down to here. So you got A, B, and then once we break the old high, and they're saying it could go up to here to this 4.3, which is, what is that, 123-ish, somewhere in the bond market, then this next wave will be a 3 of 3, which are very strong and very persistent type waves, and they're very devastating to your portfolio. So be very careful. Here's the dollar. If you want to kind of know where we didn't talk about the dollar, but if you want to kind of know where we are in the dollar, you can see we've got a 1, 2, and then we've got the first wave of wave 3 happening. So we're still going to have some more pullback in the dollar. Maybe it goes up first and then down. Okay, but then wave 3 will continue. Okay, so if you're looking to go long the dollar, you might wait for a little bit more of a pullback, maybe into this area. Sometimes we'll get a pullback into this area around 91. 91 might be a good place to enter the dollar, or short the euro, whatever your preference is. Anyway, that's kind of that. If you want to look at a really short-term chart, let's see. Here's the U.S. Treasury notes. So I just drew this a second ago. See how it just pulled right back to the trend line? So that's probably B. So A, B, and then we'll probably get a C up, maybe up into this 4.3 around 122.19 on the U.S. Treasury. He's showing the dollar index on a 120-minute chart. So he's showing B is complete, so we should have some sort of C. Euro, just the opposite. You can tell when you start to see stuff like this where there's only 4% bulls. So the euro's been going down, right? Well, the euro's been going down. Well, the daily sentiment index, this is tradefutures.com. So now it gets to here and there's only 4% bulls. Well, that's a good place to be long the euro. Okay, that's what that's telling you. Because what happens is when it gets this out of balance, just like here, where it got 90% bulls here. Well, that's too many bulls. So what does the market do? It pulls back. Okay. Same thing on the bearish side. When people get really, really bearish, there's only 4% bulls out there. That means 96% of the people are bearish. Well, what happens? The market snaps back. So the market's design is to do what fools the most amount of people. Okay, that's just the way it is. It's because it's an emotionally driven kind of activity. So here's what he's saying on gold. We've had the end of a 5-wave move, so he's saying that we should be starting some sort of move up in gold, which is what I was saying a minute ago. And same thing with silver. I mean, look there's only 10% bulls on silver. So this is a good place to be long silver. You can see the last time it was 10% bulls. It was down here at 1548, and you got a $2.25 move in silver. That's pretty good. So that's it for this week, you guys. Thanks for coming in. Thanks for, viewing the videos. If you're sharing them, thanks for sharing them. If you're not sharing them, this is about to get real exciting real fast. And, you don't want your friends and family to lose money. So share these videos, help out a friend. and let's protect, as middle class investors, we need to protect ourselves. Okay, so let's do that. All right, everybody, thanks for coming in. We'll talk to you next week. Bye bye.